They process billions of transactions a year involving trillions of dollars. The money flows through both huge repositories and tiny computers. It is their job to make sure the wealth of the world is absolutely secure. Now, banks on Modern Marvels. By their very nature and imposing design, banks are mighty financial fortresses that exude an aura of wealth and opulence. A bank's powerful structure offers the implicit promise that your money is safe inside these walls.
A bank is something very special. A bank is trust, faith that people have in the bankers, in what they do.
It is that representation of trust that is at the very core of a bank's existence. Without it, a depositor loses faith, and a bank reneges on its fundamental pledge. Within the past decade, modern technology has launched a revolution that has dramatically altered the way banks and their customers do business. A new era of electronic banking has moved to the internet, and soon it may even be possible to do your banking in the kitchen, using a microwave oven.
We realize the internet is a powerful new tool that's going to change financial services and the way they're delivered. Today, there are less than 10 million consumers doing online banking, and that'll be over 100 million in the near future.
Basic forms of deposit and lending can be traced back to the temples and royal treasuries of Mesopotamia in the 3rd century BC. The ancient Greeks developed strongholds which were used for the safe storage of valuables. The modern concept of a banking system of deposits, withdrawals, and loans began in Italy during the Middle Ages.
The word bank itself comes from an Italian word called banco, which means bench. And the first bankers, nearly 1,000 years ago, would go into the piazzas in Venice and Florence and put down their bench, pull out their account book. Somebody would give them money, they would get a credit. Somebody would borrow money, they would get a debit or took out a loan.
During the 17th century, goldsmiths in England provided a more contemporary model for modern banking.
Goldsmiths were some of the first bankers because they handled a lot of gold, and people learned that they could deposit their gold safely with them and use their accounts with those bankers.
The goldsmiths had large amounts of gold on deposit from wealthy clients, which often sat untouched for many years before it was used or returned. The goldsmiths began to loan some of that gold out to others in exchange for a promissory note and the payment of an interest charge. In time, paper certificates redeemable in gold coin were circulated instead of gold itself. When the British Empire reached across the Atlantic Ocean to colonize North America, British banking houses stood at one end of a long chain of global credit that stretched all the way to the new American frontier.
Banking only really came to the United States after the American Revolution. Before that, it was effectively prohibited by British regulations. And any banking that would have existed prior to that would have been banking done by merchants, even dry goods merchants, providing various forms of credit to their customers, or perhaps various bills, short-term forms of lending, but nothing we would formally consider as a bank.
It was a confusing economic period because so many different kinds of currency were already in circulation. In addition to British shillings and pounds, colonists were also using coins from Spain and France. Individual states also began issuing their own money of various denominations.
The first bank formed in the United States was formed by Congress in 1781. It didn't open until 1782. It was a part of the effort to straighten out the chaotic finances of the Revolution. That was the very first bank. It was in Philadelphia and called the Bank of North America.
One of its main supporters was Alexander Hamilton, who would become the first Secretary of the Treasury. But Hamilton had bitter disagreements with other founding fathers over both the necessity and the legality of a federal bank.
Of course, his great antagonist was Thomas Jefferson. Jefferson wanted to keep the government small. He wanted us to remain a nation of farmers. In Hamilton's view, banks were a key component of development. Jefferson's view was that, well, you know, the Constitution didn't mention banks. Maybe we didn't really need them.
While the new nation and its banks began to flourish, the debate over the role of banks themselves would rage for decades. By the 1800s, there were almost 700 private banks in the United States.
Early banks were not the huge institutions that one pictures today. Many banks had their origins in merchants' business, and therefore the banking business would have been done just on the floor of, say, the dry goods store. And slowly over time, the merchant might have moved into specializing in banking.
Each transaction was painstakingly recorded in longhand. Each deposit, each withdrawal, every loan recorded down to the cent. In 1848, a discovery at Sutter's Mill near Sacramento, California, changed the economics of the developing nation practically overnight.
The history of banking in the western United States is the history of the discovery of gold. Gold in the 19th century is the basis of the U.S. monetary system. All U.S. dollars are U.S. gold dollars in the form of gold coins. When gold is discovered, it creates the greatest migration of people in the U.S. history from one place to another.
More than 200,000 people from all over the world headed to California in the 3 years following the discovery of gold. The owners of a thriving Eastern Express service company were uniquely poised to handle the increased demands on finance and transportation systems that were spurred by the rapid movement of Americans headed west.
Henry Wells and William Fargo developed one of the first great business concepts in American history. The concept that Wells and Fargo developed was combining the transportation and the movement and the security of money with then banking in the form of the extension of credit.
Miners needed a place to exchange their gold nuggets for currency. Banks needed a way to deal with the sudden influx of the precious metal.
A miner in a gold field would bring his raw gold in the form of dust or nuggets into a Wells Fargo office. The raw gold was then typically put on a stagecoach, which then took off to meet either a railroad or a riverboat that would take it to a place like San Francisco or Carson City, Nevada, or Denver, Colorado, where it would be transformed into gold coin.
Wells Fargo offices of every variety sprang up throughout the West to cash in on the new economy. The gold rush had an enormous impact on the rapid expansion of banks in the United States. By the early 1850s, almost 1,600 banks existed throughout the country. Less than a decade later, another momentous event in American history would change American banks forever. The Civil War not only divided the United States, it came dangerously close to bankrupting the Republic. By 1860, there was still no national currency, and the Civil War made a chaotic condition even worse by creating an avalanche of competing currencies. Confederate states printed their own bills. Banks in Union states did the same.
Before the Civil War, all the banks of the country issued their own banknotes. Each one issued several denominations of banknotes, a 1, a 5, a 10, a 20, maybe a 50. So take, say, 5 different denominations of notes and 1,600 banks. You had 8,000 different appearing pieces of paper, all representing United States dollars.
At the end of the Civil War, the federal government mandated a single currency for the reunited nation. It enforced that order by imposing a 10% tax on earlier currency, essentially making it worth that much less.
In 1866, at the end of the Civil War, the federal government passed a law saying state banks could no longer issue these notes, and so we got federally backed currency.
Out west, the gold rush had ended, and a silver boom had begun in Nevada. But the entire banking structure of the western United States was about to be tested by one of the most devastating natural disasters of all time. At the beginning of the 20th century, the city of San Francisco had begun to come of age. The gold rush era had given it a substantial population. By this time, Wells Fargo Bank had become deeply entrenched in the economic infrastructure. Then, everything literally changed overnight.
In April 1906, a great earthquake leveled San Francisco. But the earthquake was not the worst of it. The firestorm that followed the earthquake destroyed all of the remaining infrastructure of virtually the entire city. The banks in particular were in a difficult position because their vaults were so hot as a result of the ensuing firestorm that it was days before they could enter the vaults and see whether or not, in fact, they were still in business. The president of the bank sent a famous telegram to all depositors and correspondents. Building destroyed, vaults intact, credit unaffected.
Eventually, he discovered that the contents of the vault had indeed survived intact. The calamity was also a trial by fire for another San Francisco financial institution, the Bank of Italy. The actions of its founder, A.P. Giannini, following the earthquake are still the stuff of legend. Giannini had originally opened the Bank of Italy in 1904. By 1918, he had expanded to 24 branches in 18 California cities. 10 years later, there were 292 branches throughout the state. The creation of a vast network of bank branches will be Giannini's legacy.
He saw the potential of a thing called branch banking in America when no one had ever applied that concept before. There were banks that had small branches and they were separate offices, but what AP's vision was to create a statewide network of branches.
Bankers in other cities did not exactly welcome Giannini into their territory with open arms. They saw the spread of his banking empire as a real threat.
Other bankers in Los Angeles didn't want him there. The LA bankers took out ads that said, "California does not need another Mussolini."
That did not stop Giannini. His associates said the snub served to inspire him.
He bought a little bank in Los Angeles that had been founded in 1923 called the Bank of America of Los Angeles. He held on to that name until 1930, when he changed the name of all of his banks and banking systems that he had put together by that time into Bank of America.
Giannini's vision eventually grew into the largest banking firm in the United States. Giannini's revolution in banking occurred at the same time as an American social revolution that was marked by the women's suffrage movement. But years before women were finally given the right to vote, they were actively solicited by banks as important customers, and they were enticed by promises of special treatment.
Banks recognized women were responsible for managing household accounts, and they set up special areas in the bank for women customers.
The Bank of New York was one of the first financial institutions to offer women a different banking experience from that of its male customers.
The women's room in the bank was usually sectioned off. It was private. It was a little bit nicer. Lots of times there were a sofa perhaps, or some chairs, a little sitting area, nicer plants, really more decorative, almost to feel like a parlor or a living room, to make the women feel at ease with their financial transactions. It was really a marketing angle to attract women customers and make women feel more welcome in the bank and make their business a part of the bank's business.
The bank's challenge with women was the same as it was with men, convincing them that their money was safe. One female customer who wasn't totally convinced was Hetty Green. She had inherited a fortune of millions of dollars and made millions more on her own by investing in the stock market.
On Friday afternoons, she'd go into the bank. They would lead Hetty down into the vault. She would withdraw all of her money, count it, fill out a deposit ticket, and deposit all of her money back in the bank. I don't think she trusted the bank.
It was a common theme of the era, brought on by hundreds of bank failures between 1870 and the early 1900s. The Federal Reserve System was established in 1913 to help change that trend.
People lost confidence in their banks. Banks depended upon reserves of gold and silver. They didn't have a central bank backing up the transactions. And when people lost confidence or got scared, they'd run to the bank and they would take out their money and they'd cause a mini crisis in that region. It was a terrible situation.
The Great Depression of the 1930s would pose the most monumental challenge to American banks and the country as a whole. Thousands of investors were wiped out in the stock market crash of 1929. But many banks had also made speculative investments on Wall Street. When the bottom dropped out of the stock market, it sent a shockwave of failure and despair through the American banking industry.
The fact that you had 25,000 banks all over the United States meant you had 25,000 small institutions. And in banking, what's very important is to be diversified. Be diversified in your depositors, diversified in your loans. These banks tend to be very specialized, and because they were small and undiversified, they were very susceptible to economic shocks. The Great Depression, of course, was a huge shock. There were massive bank failures across the United States. You went from having perhaps around 25,000 banks in the late 1920s to about 14,000 banks around 1933.
The failure of so many banks, combined with a nationwide loss of consumer confidence, prompted people to stop spending what money they had. That loss of demand led to a dramatic drop-off in the country's production of consumer goods, making things even worse. The result was drastically escalating unemployment. By 1932, 15 million Americans, or 30% of the country's workforce, were out of work. Bank failures fed off that vicious cycle.
I would say, in some sense, the Great Depression actually hit rural areas of America before the 1930s. Low crop prices, farmers couldn't repay their bank loans. But these were little tiny banks in places like North Dakota, and they didn't seem to have much impact on the rest of the country. What happened in the 30s is that as prices fell, lots of businesses could not repay their bank loans. Therefore, the banks closed their doors. Therefore, the public lost their money. And the idea grew that you ought to just get cash and keep it under your pillow or in your mattress.
I can assure you that it is safer for you to keep your money in a reopened bank than to keep it under the mattress.
President Roosevelt's response to the bank failures was the New Deal legislation that included banking reforms that would change the industry for more than half a century. Among its provisions, a new concept called deposit insurance.
The Federal Deposit Insurance Corporation guarantees each account up to $100,000. That's an important element of confidence. It doesn't mean much to a business that might leave millions of dollars or transfer millions of dollars through a system, but that insurance gives the individuals confidence that their money is safe and sound.
The government also took drastic action that split the banking industry into separate parts.
It was decided that because of the stock market crash and the Depression, that it would be a good idea to break off commercial banking from investment banking. Commercial banking deals with loans and deposits. Investment banking deals with underwriting securities, issuing new securities. The Glass-Steagall Act in 1933 decided that bankers would have to choose either to be commercial bankers or investment bankers, but they couldn't be both.
It was thought that banks would be less likely to fail if they were not operating as financial supermarkets. Economists today believe that bigger financial institutions are much safer because their risks are diversified. The merger between Citibank and Travelers Insurance that created the financial behemoth of Citigroup would have been illegal had the Glass-Steagall Act not been repealed in 1999. If all the currency in the 5-story vault of the Federal Reserve Bank of Dallas was stacked in a single pile, it would reach 17 miles high. It's estimated that 68 billion checks flow through the banks in the United States every year. The Bank of America's Regional Processing Center in San Francisco handles more than 4 million checks itself every day.
Fundamentally have not changed check processing in 30 to 40 years. Checks are, without question, still one of the preferred methods of moving money that customers and businesses still employ.
Up until 1950, checks were merely pieces of paper that banks processed by hand. That changed with the development of a revolutionary new encoding system. Strategically designed numbers were added along the bottom of checks that served to identify them to electronic readers.
We refer to that as MICR. It stands for Magnetic Ink Character Recognition. It basically tells you everything about that check. It'll tell you what bank that check is drawn on. It'll tell you what Federal Reserve District that bank is in. It'll tell you the individual account number and what account it belongs to within that financial institution.
In the 1950s, scientists at the Stanford Research Institute helped develop a new machine that would be able to read those ink numbers electronically. They gave their new computer a name, IRMA.
Electronic recording method of accounting was revolutionary, and by virtue of getting that accepted across the United States by other banks so that they could exchange checks back and forth technologically, that just changed everything.
IRMA could process more checks in one day than a bank's accounting department could handle in an entire year. Up until this point, banks had done their bookkeeping by hand. The development of mechanical accounting devices helped speed up the process and made record-keeping more practical. But it was still a laborious procedure. The technological ante was raised again by a little piece of plastic that would change everything.
The banks quickly realized that the credit card was a natural for them because banks are in the business of helping us make payments and they're in the business of granting credit. The credit card does both.
The basic idea of a credit card originated in the United States during the 1920s, when a few oil companies and hotel chains began issuing them to customers for purchases made at company outlets. The first national credit card plan was Bank AmeriCard, initiated in California by the Bank of America in 1959. It expanded to other states in 1966 and was renamed Visa 10 years later. The convenience of the credit card encouraged the development of another piece of plastic that acted as a key in a revolutionary new device that would change the basic concept of banking, the automated teller machine.
What you're talking about is a laminated piece of cardboard with a little bit of magnetic strip on the back. If you had suggested to someone 40 years ago that that would be the primary way most people would deal with their bank, they'd have thought you're nuts.
There are more than 850,000 ATMs in use around the world, and every day they dispense an estimated $2.5 billion in cash. Automated teller machines were first patented in 1968. The ATM was originally designed to deliver a predefined amount of money in a sealed envelope that came out of the device like a vending machine would deliver a soda. ATMs evolved into dispensers that would release various amounts of cash up to a preset limit and allow customers to conduct other basic banking functions. But what an ATM customer sees is only a small part of the sophisticated device.
ATMs are both mechanical and electronic. ATMs have dispensers and depositories. The dispenser is roughly 2 to 3 times the size of the depository. It's really the heart of the ATM, and it takes up the most space. Typically, most ATMs have alarms which will detect an illegal opening of the door. Most of them also can detect vibration and heat. So if someone was trying to blowtorch their way in or trying to knock it off its base, those events would be detected. Most of them also have some type of surveillance.
The machines also include a device called a runaway switch, which prevents the cash dispenser from sticking in the open position and shooting out $20 bills like a slot machine payoff. Banks like ATM machines because they cut personnel costs by reducing the number of tellers. ATMs also make money by generating withdrawal transactions called surcharges. They have always been accessed by the use of a customer's personal identification number, or PIN, that is physically entered into a keypad. But that is changing.
Hello, Derek. My name is Stella.
New ATMs will have sophisticated voice recognition capabilities. They'll also be able to speak to the customer.
Would you like cash, statement, or your usual?
Cash.
The new generation of ATM will confirm a user's identity through a biometric retinal scan. Your own unique physical characteristics will soon be your PIN.
We've called these things automated teller machines for years, ATMs. But the fact of the matter is, for the majority of their life, they've only done very few basic transactions. You can put an envelope in them for deposit or payment. You can withdraw cash, get a balance. The ATM is a device that needed an internet before there was an internet.
The internet now allows banks to customize their ATM machines, personalizing screen displays for individual customers.
We refer to those as products which are web-enabled. It's not at all inappropriate to think of them as street corner web portals. So if there are stocks that you are uniquely interested in, or the weather back home, is there a flight delay today that I need to be worried about? These are the kinds of things that can be customized to the individual user at the ATM.
That brings us to the latest form of banking, which is done in cyberspace. Established banks have developed their own websites to complement their brick-and-mortar systems. Meanwhile, startup virtual banks that exist only on the internet have begun competing for business in this new arena. These online institutions use their cutting-edge status as a selling point.
You have some people that are the first to get a cell phone, the first to get pagers when they came out, and they're willing to try any new technology, and internet banking is a chance for them to be the first on the block with the new technology.
Online banking created new concerns about the safety of a customer's money, as well as protecting the customer's identity in cyberspace.
Any financial transaction has some degree of risk. The biggest concern for executives at banks is that the data about their customers is kept confidential. And there's really two parts of concern. One is privacy, and the other is security. Privacy says that no one else on the internet or anywhere else could get information about that customer. And security means that the bank's assets are protected, that no hackers would go online to try and get that bank information or that money.
For most people, this is a bank. This handheld device is also a bank. The internet is allowing the banks of yesterday to be reduced in size. In essence, whatever device you use to connect to the internet becomes your bank.
In some sense, you might say that having your terminal is the ultimate form of a branch for a bank, because you have direct access to the bank and you can make your decisions very quickly.
But with all these developments in modern technology, is it possible that brick-and-mortar banks are in danger of going out of business?
When radio was first introduced, people assumed that there'd be no more need for a newspaper. Everything you could get in a newspaper, you could listen to on the radio. And the reality was, newspaper industry grew even as radio was introduced, and then of course television was introduced. So in the banking world, the introduction of internet banking is not going to mean that there'll be no more branches in the future. So we believe that branches will continue to serve a purpose, and the internet will augment that branch infrastructure.
From its simple beginnings on the piazzas of Italy, banking has come into a new era and a new age. Simple methods of accounting have evolved into the lightning-quick transmission of vast sums of money over the internet. But time and history have not changed the basic tenet of banking, the promise that their customers' money is safe. That financial security is the key issue of what a bank is all about.